I guess the PMIs, the improved PMIs, the better than expected Q1 has made this possible, right?
That's right. We've had a run of decent data recently. Manufacturing this morning was just the latest one, surged 1.1% on the month. Q1 growth was better than expected. And the committee just late last month put their flagship funding for lending scheme, effectively put it on steroids. So doing more action today would have been unlikely, and as it turns out, they haven't gone any further.
So they're waiting for Carney to arrive? Is that going to happen then? More QE?
Yep. Carney flies into town at the beginning of July, and he brings with him a liking for interest rate guidance, Fed-style stimulus, if you like. The Bank of England has to report back on the merits of that policy in the August inflation report, and we see them adopting that either in August or November, backed up by further asset purchases.
And they go hand in hand, those two, right?
I think that's right. Talk is cheap at the end of the day, so you can talk a good game, but you need something to back that up. And in the case of central banks, that's money and asset purchases.
You spent 12 years at the bank. I guess you were one of the guys who looked at these numbers, the economic numbers, and sent your message through to the committee and said, this is what we've got. Probably going to get no change as a result, right?
That's right, yes. So while I was at the bank, I did the near-term GDP forecast, looking at the PMIs. I think what I would be saying right now is these have improved, but they needed to improve. They were at very weak levels back in January and February. At the moment, they're consistent with very weak positive growth, 0.1, zeros over Q2, Q3. So there is a strong case still for further stimulus, I think, given the near-term growth outlook.
Are we going to find ourselves in a position where will require another 25 basis points in your view?
No, I think it's very unlikely that the bank would do another 25 basis points. They've revisited that issue a number of times and ruled it out because of the costs. So I think where the action will be is working on expectations of interest rates, and particularly public expectations. A recent Bank of England survey, for instance, showed that more than half of respondents thought interest rates would either go up or didn't know where they would go over the next 12 months. So there's plainly room for manoeuvre there, I think.